So let me just say out loud what a lot of you are probably thinking. And that is that mortgage rates are just being exhausting, not just financially, but also emotionally. And now you're seeing headlines saying that President Trump wants the government to buy $200 billion in mortgage bonds to lower interest rates. So I guess the real question is there a real path to lower mortgage rates? Or is it just another headline? Today, I'm going to walk you through this whole scenario, what's going on, and I'm going to be calm and I'm going to be clear and I'm going to be honest so you can just make a wise real estate decision if you have to make one, especially if you live here in South Florida. This video is sponsored by Sakava, but I'm going to tell you more about them later. Let's get into it. Even small changes in mortgage rates can shift the entire housing market. Lower rates brings more buyers, more homeowners choose to refinance, more buyers increase competition, and competition can push prices higher. So while lower rates sound like good news, and sometimes it is good news, it always comes with a trade-off. In other words, lower rates can create a second problem. If rates drop too quickly, home prices can rise because more people can suddenly, afford the mortgage payments. So we need to talk about both of these sides. What could happen to rates and what that could do to prices. What can that do to inventory? What can that do to competition? And if you're relocating, if you're buying or investing pretty much anywhere, but especially here in South Florida, whether it's Miami-Dade or Broward or Palm Beach, this matters because the market reacts and it reacts really, really fast. Let's break this down. Now let's talk about what was actually announced. President Trump said he is directing the government, specifically through Fannie Mae and Freddie Mac, to purchase $200 billion in mortgage bonds, commonly mortgage-backed securities or MBS, with the goal of pushing mortgage rates down. And the Federal Housing Finance Agency, FHFA, is connected here because Fannie Mae and Freddie Mac operate under the federal oversight. So the next obvious question then is, how would buying mortgage bonds lower mortgage rates? The idea is simple. When demand for mortgage bonds goes up, bond prices rises, right? So when bond prices rise, then yields fall. And when yields fall, lenders may be able to offer slightly lower mortgage rates. The key word here is slightly, because the mortgage market is massive and $200 billion may move the needle, but not write or rewrite the whole story. This is not the Federal Reserve cutting interest rates directly. This is a targeted attempt to influence mortgage pricing through the bond market. So you might be asking, how big could the impact be? Multiple analyses and reports have suggested the effect may be modest, not miraculous. Some commentary points to something like 10 to 25 basis points. That's 0.10% to 0.25% under certain conditions. And some coverage has highlighted that markets can react quickly at first, then normalize once the traders digest their reality. So let's translate this to real life. What does that mean to you? What does that mean to me? What does that mean to homeowners and investors? Let's say you're buying in South Florida, because, South Florida, why not? And you borrow $400,000 in principals and interest on a 30-year fix. At 7%, that's $2,661 a month. At 6.5%, that's $2,528 a month. At 6%, that's $2,398 a month. And at 5.5%, that's $2,271 a month. That's meaningful. Not life-changing, but everything counts and it helps. Now, if you are at $600,000, that's the size of your loan, then at 7%, it's $3,992 a month. At 6.5%, that's $3,792 a month. At 6%, you are at $3,597 a month. And at 5.5%, you are at $3,407 a month. Now, that's real money. That's huge. It makes a difference the higher your loan is. But here's the twist. If rates drops, more buyers qualified. And when more buyers qualify, sellers get multiple offers in the exact same house. So you might save $150 to $300 a month, but you might be paying more for the exact same house. That's why we need a strategy, not just excitement. And here's what most people miss. When rates dip, buyers just come back in, they just rush back in. So inventory doesn't necessarily double overnight, so prices tends to rise. So you might save $200 a month on your rate because rates drop, but if you pay an extra $30,000 for the exact same house, are you really saving? That's why strategy matters more than headlines. That's why a plan matters more than headlines. That's why your particular plan is important more than regardless of what interest rates are saying, what the government is saying, what your bank is saying. What have we seen already? How has the market reacted to the news? Well, the market has included this. Mortgage rates briefly dipped below 6% in some markets, just a snapshot. Refinance demand jumped very noticeably. That's homeowners trying to refinance those high percentage rates. Then rates just bounced back as broader inflation and bond markets pressure just reasserted themselves, into the market. So the headline takeaway is this. This kind of window, this kind of move can create a window, but windows can close really fast. Mortgage rates are not controlled by one policy move. They're influenced by inflation, they're influenced by treasury, yields, and also the global market. If inflation stays sticky, rates can rise again regardless of bond purchases. So I'm saying this again. This means the bond buying can create a window, but the window can close very quickly. Vigilance in real estate means preparations. If you want to make it in real estate, you have to just be prepared. You have to know your numbers. You have to avoid making decisions out of fear or being rushed. Relax. Have a plan. Make it happen. A little upgrade can change how you walk into every room. And today's sponsor makes that easier than ever. Friends, before we jump back into the video, I want to say thank you to today's sponsor, Sakava. If you love high quality style, and believe me, I do, if you like clean designs, and if you like luxury pieces without luxury prices, this is going to be your new favorite store. As a professional realtor, presentation matters to me. The way you show up just sets the tone. And Sakava offers that perfect blend of class and affordability. From designer jackets and sunglasses to premium handbags, fragrances, dress shoes, watches, and accessories, it's all there. It's the kind of style that makes you feel ready for the interview. It just makes you feel ready for that business meeting or the boardroom, or just, you want to hang out at night with the family. And here's the good part. They gave my viewers a special discount. Take an additional 10% off when you check out using my code because people matter. Or even easier, click on the link in the description below or scan the QR code that is on the screen and the discount will be applied automatically at checkout. So if you have been wanting to elevate your wardrobe, maybe 2026 is the year for you, and you want to have something meaningful, you want to feel good and look good, check out Sakava. You won't regret it. Upgrade your look without breaking the bank. Now, let's get back to the video. Let me give you 5 just deeper insights into what's going on, just a deeper layer. And this sometimes people miss this. So let's go deeper. Insight number 1. Lower rates can raise prices, especially in South Florida. If mortgage rates drop even a little bit, a whole group of people, a whole group of waiting buyers can come off the sidelines. And what happens next? Inventory is still tight in many places, so demand can rise faster than supply. That's how you get more offers, shorter decision time, sellers pushing pricing, and buyers feeling pressure. So here's a mistake to avoid. Don't celebrate lower rates without watching purchase price. Second insight, bond buying doesn't override inflation. It doesn't override treasury yields. It doesn't override the market rates and how it's influenced by a wider bond market. And if inflation stays sticky or treasury yields rise, again, mortgage rates can rise again. Some Reuters coverage has noted that bond buying alone may not push rates down much further if broader market forces move the other direction. So this isn't a magic lever, it's only one lever of many. Insight number 3, there could be political and operational limits to this whole bond buying business. Even with announcements, there are questions that the markets have to ask. For example, how fast will purchases happen? Over what time frame are these purchases going to happen? What happens if economic conditions change? And we have seen reporting point out of uncertainty around execution, especially because of the lack of details and maybe timing. So as a buyer or homeowner, your job isn't to predict politics. Stay away from that. Your job is to prepare and just be ready for when the right option for you shows up. Let me anchor this with one verse, not to be preachy, but just to keep us grounded just a little bit. Proverbs 21:5 says, the plans of the diligent lead surely to abundance. I say this a lot on this channel because it's so true. In real estate and finance, diligence looks like this. First, you have to know your numbers. You have to be patient. Don't move out of fear and don't make rushed decisions, and making decisions you can live with now, but also decisions you can live with, 5 years from now. Faith isn't pretending that risk doesn't exist. Faith is choosing wisdom in the presence of risk and taking smart actions, for sure. What are my takeaways? My takeaway is this. Number 1, just track the rate windows, not just the headlines. Don't just watch the news. Watch what actual rates you qualify for, what quotes you can actually get. That's important. Second takeaway is this. If rates dip, expect competition to rise, especially if you're home buying. And remember this, lower rates often increase competition. So your strategy matters. Financing, down payment, timeline, negotiations, all of that matter. You have to have a plan. You have to have it ready for when the opportunity arises. Takeaway number 3. Run the price versus rate test. Before you chase a rate, ask, if this rate drop causes prices to jump, am I still winning? Takeaway number 4. This is for homeowners. Don't refinance blindly. If you're reconsidering refinancing, ask, what's the break-even time after closing? Is this lowering my payment, shortening terms, or both? Am I trading a stable plan for a risky one? The refinance rule, remember, always is payment plus time horizon plus fees. Not all of it. Takeaway number 5 for our investors. Do the stress test on your deal. If your deal only works in a perfect rate world, then it might not be a deal after all. Underwrite for reality, not optimism. Here's my honest conclusion. This $200 billion mortgage bond plan, it could create some downward pressure on the rates. Maybe enough to just open a window for certain buyers and homeowners that want to refinance, but it's not guaranteed, and it's definitely not permanent. The real win is not guessing right. The real win is being prepared so when the opportunity shows up, you can just move with confidence and peace. The next video you should watch, because it just connects directly to this topic, is should you buy now or wait for lower mortgage rates here in South Florida? Because once you understand rates, the next question is timing, and timing is emotional. And if you have not subscribed yet, please do so. It would mean a lot to me and to my channel and to what we're trying to do here in living in South Florida. And I promise to keep providing you with just real estate advice without drama, without flying cars and bombs going off and the end of the world is happening. I'm just gonna give you the facts as I know them, and information that might save you thousands or help you earn millions. That's what I'm here for. So please subscribe, like the video, and share it. And, perfectly, I'll see you on the next video. And remember, as always, God loves you, and so do I. Bye-bye.